Good morning or good afternoon whenever you're watching this. This is Nathan Buckhoff, VP over here at Oxford Partners. I have on the line with us Matthew Rogers, Senior VP here at Oxford Partners. He and I both do a lot of industrial work around Houston and Texas in general. So today we wanted to talk a little about industrial trends, things that we've seen over the past year or so, and just give everybody a little bit of insight as to what's going on in the city.
Yeah, absolutely. Looking forward to it. I'm sure there's lots of questions and lots of things changing on the fly. Happy and excited to get into it.
Excellent. One of the things that I've seen is we've had a lot of demand with industrial, but the market's changed. Like the past couple of years, industrials remained very strong. It's been one of the only asset classes that even through COVID, vacancies continued to go down, rental rate went up, and there's still a big demand for it with everybody moving to Texas and specifically to Houston. But things are changing a little bit. I don't know exactly what you're seeing, but I've seen there's still high demand, but there's just not as much availability. It seems like maybe Houston or developers around Houston are trying to catch up with that by throwing up a bunch of tilt wall distribution type spaces or throwing a lot of different flex type spaces. What are you seeing?
Yeah, that's a great point. Seeing a lot of the same. Frankly, COVID changed a lot of things about the industrial makeup of Houston. The world changed. But I think that there needs to be a separation almost of smaller and larger space. Anything under 30,000 feet is very difficult to find, and pricing has been expanding quite rapidly over the last 15, 18 months, whereas it's been doing the opposite. Big bulk spaces are not leasing nearly as fast. They're sitting on the market quite a bit longer. So looking at it, you separate out the two, and it's two very different outlooks. But most of the space coming on the market is that bigger product. So that's what gets seen, I guess, overview style a bit more under the microscope.
Yeah, that makes sense. Like even driving down Beltway 8 towards IAH, I mean, you can't miss that giant sign that says 150, 160,000 square feet available for lease, but it doesn't seem like a lot of smaller ones are becoming available. The ones that have been available have just been snatched up. It kind of ties into the second thing I wanted to talk about under this point is the smaller industrial spaces have been outperforming those large bulk warehouses, especially when it comes to leasing. Do you think that's just because there are less of them out there? Is it because more people are trying to start their own business, whatever it might be? Is there a higher demand for it?
I think it has to do with a couple of things. I think a big push of why those big bulk spaces were so highly in demand during COVID is because of the Amazons and third-party logistics providers that just expanded so rapidly, accepting a new lifestyle in the world of third-party logistics that are just to end users. So those spaces got taken down very rapidly, whereas the smaller spaces are your more mom and pops, local companies that are growing, doing what they're doing, and there's just still more opportunity there. Whereas those big bulk spaces, there's just not as many people out there looking for tenants. I've heard stories of you got 4 or 5 developers all fighting over the same one Amazon requirement or whoever it is. And they're not going to lease all 5 of those spaces. So only one of them is ending up going to get that deal. Whereas for smaller spaces, I've been in situations where I'm one of 6, representing one of 6 tenants that are fighting for one space. So obviously that difference in dynamic creates a much different situation in negotiations and what we're seeing. And I think that's a big part of it is that there's just more players in those smaller spaces currently, and that's what's driving it. Not that changes the outlook on Houston at all. I think it's very strong. We're very, very well situated for the future, especially as manufacturing is appearing to come back to the United States. We've always been an oil-heavy manufacturing hub here in the United States, and that's in part because we have the port, we have the oil side, and we just have the makeup of our city helps with some of that. So I wouldn't be surprised if it all continues to grow, but there is a light lag on the bigger stuff currently.
Yeah. Excuse me. Yeah, I agree. I've definitely seen that. Everybody wants to catch the big fish. Everybody wants to have the 100,000, 200,000 square foot user, but there's just only so many of them out there. Something else that I've seen, and maybe these two kind of correlate to each other, is we've had a lot of supply over the past couple of years, and it's starting to moderate off after we had these record-setting deliveries. I don't know if we just overshot that, but we had 20 million square feet delivered in 2024, but new construction is starting to slow down. I don't know, maybe that has something to do with where interest rates are or the cost of construction materials. What have you seen?
Yeah, I think something that has always been interesting from my perspective is that 20 million feet of deliverable last year isn't new. It's almost been that for the last 5 years running, to the point where I was expecting it to hit a few years ago, but it didn't, with COVID happening, and that, we talked about, that big third party logistics push started eating up a lot of that space. So it's not something that's super surprising to me, because you can't keep building at that rate and backfilling it. It just, unless some major dynamic changes, like is exactly what happened. These projects take so long to get up and out of the ground that it's hard to say whether interest rates and things going on right now really affect things. Because if you're looking at doing a development, you're more than a year and a half out from getting those buildings up. So the lag of what's going on right now really won't be felt for a few years. I think something that does play a part is that the city dynamic is changing. Historically, we were always a very expansive city, but we really were built internally. Now the Grand Parkway, which is a major thoroughfare for the city, used to be considered out in the boonies. Frankly, it was way out there, only maybe some residential stuff. There really wasn't a ton of industrial or development out there. And Exxon years ago went in where they did up on the north side, and the expansion started where internally in the city, those historical industrial sites are getting reconverted to multifamily, residential living, high-end residential, whatever it is, because the tax basis on the land underneath it has just pushed it out. And thankfully, Houston's well positioned because we have the room to expand. Most other major metroplexes in the US do not. They're capped on their space to grow. It's another reason why I'm bullish on Houston's future, is that they do have room to expand out. Now, the problem becomes the dirt price. And part of why they're moving is because the dirt it's sitting on no longer makes sense to be an industrial asset. So they look at expanding out to where the dirt is a bit cheaper, but you still have to have the sites. And a lot of that land is already controlled by major residential players for future neighborhoods, things like that. So finding the locations and stuff where you get the access and things you need to have to put up tilt wall warehouses is getting more and more difficult. So these projects that are coming out of the ground now have been planned for years. Those developers acquired that dirt and have been planning these projects, and just so happens they come out of the dirt. And now we look back and say, how did we get here? And it's always a good question and a good discussion, but it's going to be interesting to see how things play out with, if these tariffs hold and some of the construction pricing, and to see where our world goes. So it's going to be fun to watch. A challenge, but in our world, there's always challenges up or down, but it'll be interesting to see where it goes. I wouldn't be surprised if pricing on the bigger stuff does hit a wall, because it did take a jump if that hits a wall, but we continue seeing a rise in pricing on the smaller, I call it 10 to 25,000 foot spaces, if that continues to go up, at least until the supply and demand gets rectified on that front.
Yeah. Yeah. Even like out Tomball, Cypress, even going towards like Buckley and Waller. I know Johnson Development has bought thousands and thousands of acres, and they're just sitting on it, planning for future development, just like you were talking about. Do you think that's a reason or an indicator that a lot of developers are becoming more selective and focusing on like those high demand submarkets and build to suit projects versus what you said earlier, just throwing up 100,000 square feet of space and hoping they can backfill it on the end?
I definitely do. I think the interesting part from being on the tenant side of the equation is that for us, it's always about controlling costs for our groups and trying to make sure we get good, fair deals and take care of them and what their interests entail. But just from a market standpoint, these developments getting pushed further and further out, industrial developers like their price set at a certain amount per square foot, and they don't like to grow that number, because it starts to eat into their overhead, and on the back end they have to raise their rent prices to still incorporate their profits, and it starts to push things into an uncomfortable place. But frankly, there's not more dirt coming. As the city continues to build outward, there's just less and less. Simple from supply and demand, the price per dirt goes up as there's less of it. And those residential developers that hold all that land, I don't know that they're going to let that go, because that's where a majority of the city's growth is. And there's no end in sight to the city itself growing. Texas is bringing in more and more people just because of our focus on business. So lots of business owners are coming here. Lower cost of living helps in some regards to that. But what I think is happening is out there in those farther west and northwest markets, is that the price per square foot for small single use properties is just skyrocketed because there is so much demand. Everybody, all your principals and business owners that live out that way don't want to commute all the way back into town. So they look local. If they can come up, get their commute down from an hour and a half to 15 minutes, it almost becomes, and there's plenty of labor there. They look at paying these more exorbitant prices per square foot on the buildings. So we have seen a push for some more smaller, kind of call it 6 to 15 smaller industrial single use building developments out there, because there is a high demand for that. And that won't change as long as those developments that are due to come out there continue to happen. That demand will always be there.
Yeah, yeah, I agree with you. That demand has remained strong ever since I've been in real estate. I've always seen people that need 15,000, 10,000 square feet, and it is just hard to find. But pricing still remains pretty strong. Even the past couple of months, rent growth has started to slow. We've had years of that double-digit growth, and from what I've seen, rent increases have not stalled, but slowed down to around 2% annually. I don't know, maybe that's people are looking towards more well-allocated, smaller logistics spaces, and those just continue to have a premium. And maybe that's why the pricing is staying so high. Your thoughts?
Yeah, I think I mentioned this briefly a little earlier. I think it almost needs to be a twofold conversation, because if you just look at universal kind of market numbers, the big bulk stuff is just by volume takes a bigger chunk of that. So if you're looking at it in a vacuum, it may look like it's only 1% to 2%. And those big bulk stuff, yeah, those prices are fairly locked. And if you come out with a new asset and try to push that, you're not going to get at least, because there's something similar down the road that's cheaper. So the big bulk stuff is pretty locked in pricing, and I think it will be that way for a while. But you're still seeing 30 to 40% growth over 2 years in the smaller stuff. So that's why I say it's almost a twofold comparison, because it's almost weekly where we'll start working with a new group, and they're in usually inside closer to town and in northwest, southwest, east side, wherever it is. And we'll get a renewal proposal that's 50% more than what they're currently paying. And it's just utter shock from our clients. So having those conversations is tough. And that's why I almost want to segue those into two conversations, because I really feel like it's two different markets entirely that just happen to overlap. So if we're looking at it overall, I agree. There's not much growth, but that's because in the bulk side, there isn't. And then in the smaller user side, there still really is. But overall, it washes out to where it's probably 1%, 2%, 3%, something like that year over year.
Yeah. Yeah, whenever you take everything into consideration, almost that bulk stuff starts to seem like an outlier, because it doesn't paint a full picture of what the smaller to medium-sized industrial market looks like for Houston.
Yeah, absolutely.
Okay. Switching gears for a second, wanted to talk about kind of investors and investment sales, because I know that's something you and I have done in the past together. It's something that you're well versed in. What have you seen when it comes to underwriting? Have they been a little bit more conservative? Are they more gun shy to get deals closed? The interest still remains strong. I've seen multiple cap rate sales around Houston and the greater area of Houston, but it seems like some of those deals are a little bit more difficult once it gets to the title company.
Yeah, industrial sales are an interesting beast, because you're different dynamics from a user sale. But the hard part with investment sales is that the interest rate really doesn't help. If they're borrowing money at all, it's very difficult to make the numbers work right now, unless you're specifically focusing on a value add type asset where you might have a low occupancy and maybe bad buildings, and you go in, clean it up and get the occupancy up, or whatever the reason might be. But just a standard nice class B, class A asset that has a tenant in it, that frankly, the price of on the purchase side has outpaced the lease side. So it's made getting what used to be a world where you could look for 8 caps and maybe even 9 caps out there is very difficult to find now, because it doesn't take long running comp or just looking at available on market stuff where it's nowhere near that, because the price per square foot on a purchase just shot through the roof, and the rent just hasn't followed as in tow with it. So your cap rates have shrunk while also having your loan money go up, your interest rates up. So it's harder to make the numbers work. So a lot of the stuff that we've worked on, we've been I'll call it, in a good situation where some of our clients have had cash to where they could go in and buy it cash. So we can look at the opportunities a little different, whereas we can look at maybe year 2, year 3, we get that cap rate more in line. So where they're not so dependent on the financing. And then once we get it in place, we can go and then look at financing on the backside or different creative ideas, or just hold it in cash as an investment. But it has been difficult to find, whether you're looking at just trying to find a building that has a income stream in place, or even looking at something that's vacant and you feel confident that you can go and get at least. It has been a challenge, but we've still been able to get some creative things done just by having people that are willing to look at market areas where we feel strongly about, or finding creative ways to invest their money where it's not just about that income stream day one. Maybe it's a deal where we structure it where the bumps are more, or we feel strongly about the area and a valuation grow over a 2-3 year period. So you just, right now, if is a good time to invest, just because if you have the cash on hand, you can find some opportunities, but you just got to be selective. There was a time where people were just throwing money at Houston, Texas, and you couldn't miss. I don't know that's where we're at, but if you have savvy investors that are open to looking creatively at opportunities, there are still some good ones. You just got to dig a little harder for them.
Do you think that's a reason that me personally, I've seen more private investors, or call it a local investor, like 1 or 2 folks that are looking at purchasing a property if they do have the cash, versus these kind of giant REITs or REITs that traditionally take out loans and try to leverage their assets and debt to be able to purchase these buildings?
Yeah, I think the interest rate and banks being a little bit more strict on their loan programs. There are still some out there that are active, but a lot are still underwater on the office side. So they've tightened up their regulation on their lending. So I do feel like that's made REITs and other bigger investors have to get a little bit more creative about where their joint partners come from in the money side. There are, like I said, there are still some banks out there that are willing to play ball. It's gotten tougher. So I think that's partially why you've seen less volume of those bigger portfolio sales happening. That is a big part of it. I also feel like a lot of them are still curious to see how all of what's going on right now plays out. The ones that are changing hands are typically doing it behind the scenes, and we're not seeing a ton of big portfolio sales hitting the open market per se that aren't just behind closed door deals. And I also think that plays in because you'll see a lot of these newer developments coming out of the ground for sale, which historically never happened. Typically, developers would bring them out of the ground, lease them up, and then turn to sell them. But we see big vacant bulk buildings on the market for sale pretty frequently now, which never really happened before, which I think is also a tale of the times on that bigger stuff, which also makes it hard for a REIT to go and grab a couple more buildings when they're seeing other competing properties on the market sitting for sale or for lease. I think that's a big part of it, but I do think the financing side has created a big chunk of the challenge for them.
Okay. Yeah, that makes sense. I want to go back to talking about the specific type of industrial assets. Not as maybe assets is the wrong word, but the specific product types with industrial. You can't drive around Houston without seeing all of these tilt wall distribution spaces going up. But I know you and I have met with folks in the past 4 or 5 months that need manufacturing space or more specialized industrial space, and there's just not a lot of product out there. Do you think that there's been an increased demand for manufacturing facilities or types of properties that do have overhead cranes? And if so, what do you think is causing that?
Yes, I do feel like it's become increasingly challenging to find manufacturing type space with special amenities like cranes. I think there's a part of it that in lies that's just not a product type that's getting heavily developed on spec. So the existing facilities that are out there are what's there, and there's not a ton of that product hitting the ground because it's expensive to build that. So not that it's not a need. I just think that developers are going a different route because of that initial cost on the front end. And then also you're just seeing those companies, not that the heavy manufacturers move a lot because they don't. They're more stationary and sticky to their buildings because it's hard to move those operations. But you're seeing even less of it because I think as we find, it's hard to find relocation spots. You can say, yeah, I need more space or I'm ready to sell and find something that fits us a little bit better as we're adjusting our operations. But there's not a ton of options to go out there to find to relocate. So those buildings that historically would be companies would be switching around, buying, selling, moving, making some of those things happen, aren't happening as often because there's not supply to go move to. So then they in turn don't put their buildings on the market. So it's become a little bit of a shell game of finding space when you have one of those manufacturers. And I do think it's going to become a bigger issue as we see if more manufacturing does get pulled back to the US with some of the stuff happening. I do think it's going to be a problem. I know when I first got into this business like 12 years ago, I remember there was a big push of developing those smaller single user manufacturing operation crane served or crane ready buildings that came out of the ground because there was a glitch there. There was not enough product. There was a delta that needed to be filled, and savvy developers went and did that and did very well on those type buildings. So I do feel like that's going to be an ongoing problem, and we'll see how it plays out. We'll see if maybe some developers turn back to that type of product instead of the big bulk distribution, because there is an argument for coverage. Frankly, you're not going to get as much coverage on your land tract doing those individual buildings as you would a big bulk distribution building. Just pound for pound per square foot, you're going to get more building coverage on a big tilt wall facility. But is it what's going to lease out faster? And does it make more sense to go the route of the single smaller use buildings? And that's where I would be telling people to go, because those will lease out. You can move those and flip them. And the value in those is growing day over day. So it'll be interesting to see what happens here over the next 12 months or so.
Yeah, I mean, that ties into what I wanted to talk about next. Neither of us have a crystal ball, but if there is a boost in demand for domestic production, those manufacturing type spaces are going to be in even higher demand than they currently are. Go ahead.
No, I was just going to agree. Totally agree. And I feel like, I don't know if this is where you were going, but finding them also to purchase anything, not even manufacturing specific, anything under 30,000 feet has been very difficult to find, if not impossible. And there's some big shock value with what price those are being sold at. Not 2-3 years ago, you could find new buildings coming out of the ground for like 130 foot to the shell for smaller stuff. Now you're priced in the 160, 170 range. And if you're in a hot market area, it's more than that, which 3 years ago I would have thought was crazy. But this is where we're sitting now, which is unfortunate, especially because the side of the table we sit on. So got to be more strategic and make sure when you're out looking, you're out buying something that it's in an area that benefits the operation. And then also you're accounting for future growth, because when we're advising people, we don't want them out having to look for something in 2 or 3 years, unless something great happens with their business, because it's going to be more expensive than it even is right now, I think. So if you're going to make the move and go through that expense, let's get something that'll solve your growth solutions for a few years so that you're not having to look at doing this move 24 months from now.
Yeah. Competition for those types of spaces it's been insane. I can relate to what you said, I think, at the beginning of the interview, where I personally have had tenants or buyers that are looking at between 10 to 20,000 square feet, and we'll go in, we'll look at a space we think's great, and we almost have to pull the trigger within 2 to 3 weeks of actually looking at the space, because they've got 4 or 5 other potential buyers or tenants looking at it that also need to move quickly, and they also want the space. And they all know that maybe they don't all know, but most of them know that there's almost nothing else around that area unless they want to drive 5, 10, 15 miles away to find something else.
Yeah, that's incredibly true. And frustrating experience, but I have a client's commercial glass company, and we literally were going under contract on a property, and we probably got through that within 8 to 12 days, somewhere in that time frame. And enough, before we could get it even countersigned, someone came along and offered something better, and we lost out on the deal. It's just unfortunately a situation right now where you find something that fits and it fits the budget. You got to act quick. And I know it's hard because you're operating a lot of decisions. It's a big decision for these companies, and there's a lot of operational side to it and making sure it's the right move. So it's unfortunate, because the last thing we want to do is put any pressure on anybody to make a decision. In fact, we want the opposite. We wanted an educated, comfortable decision that they know they're making the right choice because we've looked at everything. So it is tough, but if you don't act fast enough, you do miss out on these opportunities. Like I said earlier, at some points, there's 4, 5, 6, 7 groups all vying for the same space. And that does not create a great leverage negotiation platform for us. It's do what you can to get the building, and let's just not make sure we don't overpay the situation. And that's definitely the case on anything purchasing under 30,000 feet right now in town.
Absolutely. I want to talk about the port for a moment because I know the port's been expanding. They've got future plans to continue to expand. And I think that's going to continue to drive logistic driven type properties in some markets. Again, we don't have a crystal ball, but Houston has been one of the most productive ports in the country. And there's only so much room to grow on that east side of town. I guess what have you seen? What are your thoughts?
Yeah, the port, frankly, Houston's just a little lucky in where our port is located on a map, just because it fits checks a lot of boxes for companies, and lots of the Midwest, lots of stuff north of us depends on our port, kind of ship it here and then it gets trucked north, and then obviously fulfilling all of the businesses here in the Houston area. So it's definitely a great support structure for the growth of Houston. It's interesting because on the east side of town, there's lots of older product. A lot of the history and manufacturing, older heavy duty stuff is on that east side of town. And it's interesting because some of that stuff still hangs around because it's just stuff that doesn't get built anymore. Heavy power, heavy crane, large clear heights, just different types of facility than what comes out of the ground in today's world. So that stuff is still hanging around because there's operations that need that stuff, especially stuff that gets barged in and needs the rail access. So there's always going to be a need for that. I think it gets interesting because going east of the port, there is land out there, out in Baytown and some other areas, but they've taken an interesting objective in trying to solidify their residential side of the world. So it's going to be interesting because there are companies that absolutely have to be tied to the port, and there's not a ton of available space on that side of town. So there's always pretty high competition for it. So it'll be interesting. And as the port expands or attempts to expand and grows, there's also an LNG side component to it that's growing and expanding pretty rapidly over there as well. That's really one I don't have a crystal ball on, but we are a very fortunate city to have our port there to support the city.
Yeah, I almost wish I could figure out what's going on with Baytown because I do a decent amount of work out that way, and a lot of it has been industrial. And I've even last summer, I had to have a meeting with the mayor of Baytown because we were looking at purchasing a 15,000 square foot industrial building, and they were rezoning that entire area. And if we would have bought the building, we would never have been able to sell it. We wouldn't have been able to lease it out if we wanted to do that. They were going to rezone that entire area to be residential, and the only way we would have been able to get around that is by buying the building before they passed those ordinances, whatever you call it. I don't know why they're trying to push out so much of their industry. Baytown in that area, there's residential there, but it's a working town. That's where we have so many of the huge oil and gas plants is out there. I don't know why they would want to push that out. I don't know what's going on behind the curtain there.
Yeah, I have to second that. I'm not entirely sure. Being as tied to the port as they are there, it seemingly would be a no-brainer to push an industrial initiative and grow the tax valuation there via that platform. But that said, it gets into an interesting topic. I don't know if you want to cover this today, but zoning. In Houston, we're the Wild West a little bit in that we don't have zoning, but some of our surrounding cities and areas, Baytown being one, City of Pearland, LaPorte, some of these jurisdictions around us do have zoning. So as you look at relocating and things like that, you got to be cautious of that, just making sure you can actually physically operate where you're trying to move to. You guys experience that firsthand, but as things are adjusting, a lot of these cities are moving towards prettier products or residential even, and pushing out some of the industrial. So it makes our world a little bit more challenging.
Yeah, it does. That's a good analogy, Houston being the Wild West. A lot of people that I've worked with when they come to Houston and specifically Harris County, they've never dealt with a city that doesn't have any zoning laws before, and it baffles them. They don't know what to expect or how to understand it, but it is unique, at least from where I've worked.
Yeah, it is. We still have a lot of oversight from fire marshal and other code compliance stuff, but not having zoning in a way makes our world a bit easier. That's just one thing that we don't have to work through on every single deal. I mean, it's also part of what makes our city unique. You could have a house next to a commercial business that's right next to a distribution warehouse. So it is a big part of what makes our city unique, but I think it's more of a business forward mentality. it supports businesses and doesn't get in the way. But over time, we'll see how it plays out. Obviously, detention and other things have been upped over the years, and you have to have some oversight. So it'll be interesting how that all plays out over the next decade or so. But that's probably another conversation for another day.
Yeah, that's a much longer conversation than what we have time for today. I want to, excuse me, I want to go back to talking about developers a little bit and looking at the types of products that are coming into Houston. I want to know what you've seen, but I've seen that developers are scaling back on some projects due to rising costs and like the financing challenges that we talked about earlier. But I've seen an uptick in build-to-suit products. I think that there are a lot more companies that are looking for a customized long-term space because they don't want to move again. They don't want to, in 3 years, have to pick up all their stuff and move down the block.
Yeah, I think it's twofold. I think developers are putting those marketing opportunities out there because it is a little more difficult right now to get buildings pre-leased unless they just knock out of the park on a location that just has direct access to I-10 or something. It's difficult to get anything pre-leased, so they put stuff out there on the build-to-suit market so that they can entice people that do want to be a part of the building process, get something designed specifically to their needs, and it gives it an opportunity to connect with a user they might not if they had done a spec build. So I think that's a part of it, but I also think it's especially sitting on our side of the table because we get asked this a lot. People like the idea of building their own building, but what they don't realize is it's one of the most expensive routes to getting what you need. Now, there are plenty of companies that we talk to that have a very specialized operation and use that it might require that, but there are also plenty that could buy an existing building and retrofit it to their operation and still be significantly under the budget of what a build-to-suit building would cost them to get. And the timing is not something that they prepare for. I mean, to look that route, you got to be at least 18 months out to even look that direction. Maybe a little quicker if you can find somebody that has all of the soft cost, all the actually tilt up work done, but most tenants are not that forward thinking, unfortunately. So the timeline alone does rule it out for them at points. But I think that's another interesting conversation because I do think build-to-suits will become more occurrent or will happen more just because developers are going to be a little more hesitant to go ahead and put those buildings up. And if they can find somebody that wants to come in and do something more specific, they're going to maybe look for those opportunities maybe a little bit more than in years past.
Yeah, that's exactly what I was thinking. I would wager that you're right. Developers are more hesitant to put up buildings and have them sit there until they get leased. And then on the flip side, it's more attractive to potential tenants or buyers to look at a site that, like you said, already has the soft costs taken care of. They've got utilities, there might be a pad there, they've got kind of power ready to go, and it makes it a much shorter putt for them to actually be able to build their building versus finding a piece of land and then having to potentially pull utilities, get with CenterPoint on trying to hook up the power. It makes it more reliable for the investor, or I guess the developer, to actually have a buyer or a tenant before they build the building. And then it also makes it easier and a shorter, it's still a long timeline, but it is still a shorter timeline for the tenant or the buyer versus finding a piece of land and having to go from the ground up and greenfield something.
Yeah, absolutely. And those are conversations we do have quite a bit just based on what we do and who we interact with. But I second all of that. I think it's going to be an ongoing situation to watch, but I would not be surprised if we start to hear more build-to-suit type deals come through on the press and marketing side. But I still stick with, I'll always tell groups, hey, let's explore what you do on your operation side, and then we can look at what works best, because there's no like perfect fit unless you do ground up, but that's going to be expensive and long. But there's lots of ways to achieve what you need to be perfectly functional and operational, and we can save you 30-40% off what that cost might be. So I always encourage people when I start having these conversations to, hey, let's go explore multiple ways of solving the challenge of what you have.
Yeah. Two more things that I want to talk about. They somewhat relate to each other, and I know you've got to go, so this is the last two things that I want to talk about. But I know, so population growth is something that we talked about earlier in this, and just Houston having the geographic area to be able to keep up with that demand and that population growth. Long term, do you see Houston still remaining as a key industrial hub with that growth potential over the next 10, 15 years?
I do. I do. And it's as simple as just basing it in what the city's founded on. Oil and gas ties are nice, but we also have a great medical center. Also, the port here to continue to bolster growth in industrial business. But the space thing, I think, is huge because lots of companies, when they're evaluating relocating a headquarters or operationally moving a work staff, moving them somewhere where they're not going to be tied to what they're moving to and have that ability to grow is huge. So I think Houston, Dallas, Texas as a whole is really positioned well for that. Also, one of the biggest ports in the entire United States is a land port here coming through Laredo. There's so much traffic moving trucks through that port from Mexico. It just so much industrial support happens here in Texas that I can't see a world where it wouldn't be well positioned over the next decade. Plus the fact that we are, again, one of the few that has the opportunity to grow and has the infrastructure already in place to do that. Because I think that's the other side is there's lots of other cities where they might maybe have the space, but there's no infrastructure to support that growth. Whereas Houston does have that. Yeah, nobody likes traffic, but frankly, the fact that the conception of 99 was created in the 60s is just gives a nod to the people that built the city on the front end, having that forward thought of where it could go. So yeah, 100%. I incredibly strongly believe in Texas as a whole and definitely in Houston.
And then I guess coupled with that, long term, what are you telling your clients long term kind of strategic moves? What should they be taking into consideration when they're looking at their long term planning when it comes to staying in the city or staying here in Houston, as it pertains to their real estate?
I would honestly say that's case by case because what's important to one company isn't as important to another. The three big ones that we come across are typically drive time, so location to either the executive team or the workforce, and then relative closeness to clients and support people, and then material. Where is their raw material coming from? Whatever they're fabricating or whatever they're doing, how close are they? How much is the trucking cost from that, getting the raw material from the plant or the port or wherever it's coming from to their facility? Those are three of the bigger drivers of relocation and what's important. And to each different company, it's a little different. Whenever we sit down with somebody, we want to go through all those things, talk through what their growth looks like, and try to be an advisor, an asset to them to help them think critically through all of that process so that when it gets down to it, we've narrowed down what are the most important items, and then we focus on those. Because looking citywide just logistically doesn't make a lot of sense for a lot of companies because you move too far from one or two of those things and it just changes the operational dynamic and they'll lose employees and it's just not feasible. So having good, honest educational conversations with them through all these things that we've seen and worked through with others can help them really narrow down a search radius and focus on what's going to be the most important for their business success long term. So it's hard to put it into a crystal ball of exactly what that looks like because there are so many different factors that go into it. But I think critically thinking through a lot of those things is the biggest and most important part, because then that's what gives you a little bit clearer picture of where and what you're looking for.
Yeah, that makes sense. I'd say whether folks are looking at leasing, investing, developing, the market shifts here in Houston and the trajectory that the city is on as a whole are creating opportunities for people who act strategically and, of course, take advice from the good brokers down here at Oxford Partners.
Absolutely. One thing I will add, and then we'll leave it, but I also encourage to any user, smaller user that can make the money side work, at least explore purchasing. It's just a much better long-term solution and also creates equity. And there's so many values adds to it for them, just in the sense that they don't relocate all that often. So if you can get into an asset, there's tax advantages and a lot of other things that come as positives to looking into it. We at least like to explore that. And if it's not feasible, that's fine. Happy to find a relocation and lease and all that. But it is something that we at least advise exploring and walk through whenever we try to sit down with new groups.
Yeah. That makes sense. I appreciate you taking some time to speak with me this morning. For anybody who's watching, thank you for making it this far and taking some time today to watch Matt and I chat about the industrial market and what we've seen and where we think things are going. If you have any questions, comments, concerns, please feel free to reach out to Oxford Partners. Matt and I are more than happy to talk with anybody and everybody about industrial markets and where we think things are going and to offer our advice.
Absolutely. Had a good time. Let's do it again soon.